Okay, so like I said, tactical investing. Now, nobody knows what's going to happen going forward. Of course, we don't know whether this current crash is going to be the big one or whether things will kind of calm down and go back towards the all-time highs. We don't know that. But I think one thing that a wise investor could at least acknowledge is that we may be at the tail end of this fairly long bull market cycle. Of course, we had the pandemic, but does that even really count? It was a massive V bottom. They flooded the market with capital. Not a whole lot happened then. It's actually been a pretty long time since we've seen an extended recession. So it is wise for investors to know that at some point that's going to happen. And like I said, I believe tactical investing style is what's going to save people and allow you to thrive in that environment. Now, I've got a lot of videos on the channel about this. I'm not going to really get into what it is, but just super quick to catch everybody up. This is our tactical volatility strategy. And with this one, I'm dividing the market up into different volatility ranges, and then I'm only allocating capital to the asset classes that perform best during those ranges. So of course, during stable, calm markets, there's absolutely nothing wrong with being aggressive. We'll be holding short volatility in that range. But when the metrics elevate and they're showing risk, this is when we move into the GLD gold for safety. And then in extreme volatility, when those levels are really high, this is only on about 2 or 3% of trading days, but there are times when we can actually flip the switch and go long volatility and actually try to capitalize and make a profit during the market crash. This is what I mean by tactical investing. And within this strategy right now, we are actually in gold. We've been in gold for a couple of weeks, kind of in that middle wait and see ground. Not high enough to go long volatility, but certainly we've seen the market go down and we were lucky enough to avoid most of that. Defensive rotation is another tactical investing strategy. This one using different volatility metrics, different ranges, different asset classes. This is how you diversify a portfolio using different strategies. And this one is currently in cash, so it's been safe for a while now. And then strategic tail risk, again, different assets, different ranges, thresholds. But this one has been in the IYR real estate for safety since then. And then if you tuned into the live stream last week, I basically dedicated to Bitcoin, but I also trade on the side a Bitcoin strategy that is somewhat similar. And right now, this one is in fixed income for me, which has again been nice because Bitcoin has had a pretty rough go the last month or so. But that's tactical investing. And the payoff is this is our performance in the tactical volatility strategy since we moved to safety. So you can see what happens. Sometimes there's a few days of chop when the market is kind of figuring out what's going on. But because we exited to gold all the way back on February 21st, we've kind of just been watching this crash from the sidelines in safety. And you can see recently it has quite accelerated and the SVXY is down about 10%, but our strategy is down less than 1% because we were in safety gold. Defensive rotation, kind of the same thing. We exited to utilities and then to cash. And so no matter what happens going forward, let's say this 6% market crash that we've currently seen, what if this thing goes to 10 or 20%? Or maybe, like I said, hey, who knows? Maybe this is the big one. It goes to 50%. Well, obviously this strategy is going to be just fine. Oh, I can see a little typo there. Forget about that. That should say defensive rotation, but it's actually only down less than 2%. Whereas the NASDAQ that we're actually trading, the QLD down about 10%. And then lastly, strategic tail risk, again, kind of the same thing. We cycled into safety, IYR real estate. This is a position that does perform much better than stocks when the volatility metrics are elevated. And this strategy is pretty flat, whereas the underlying S&P 500, since we moved into it February 24th, is actually down. We'll see what happens in the future. And then just really quickly, as far as the actual long volatility positions, like I said, these don't trigger very often. We very nearly got that signal there on March 6th, as you can see. If that were to have happened, this is what the strategic tail risk would actually look like today. Because of course, March 7th, the market was down again. Long volatility did very well. But I'm showing this to say that this is kind of what I'm talking about with tactical investing. We don't know when the market crash is coming, but when it does, there is absolutely an opportunity for profit. I'm currently sitting in a portfolio that's very safe, right? Iron condors are basically in cash, and then we're in gold, cash, and IYR real estate. If the market does crash from here, I'm expecting to do quite well going forward. But this is what I mean by tactical investing. And so why do we actually want to do this? Why would we tactically rotate to safety? Well, there's three main reasons, and the first one that I will highlight is what I call preserving emotional capital. Now, a lot of people are hyper-focused on their actual capital, their financial capital, the dollar value of their account, which obviously is very important. But what I mean by emotional capital is the more times in the market that you can avoid disaster and avoid making mistakes and avoid riding those drawdowns down, That's going to give you mental preparation to make better decisions in the moment. If you're that type of investor that is quite risky and you don't cycle out into safety, so you've had multiple big drawdowns in the past, it kind of gives you that PTSD, that shell shock thing where you really don't know what's going on, and it can definitely lead to you making very poor decisions in the moment. You'll think back to those times, well, I didn't exit this time and I lost so much money, and should I exit now? I don't really know what to do. Preserving your emotional capital by setting up a portfolio that doesn't give you those fears and those butterflies in your stomach, that you can kind of just sit in safety and actually feel comfortable. Like I said, right now, I don't feel scared about what's going to happen next week. Now, gun to my head, if I had to guess, I would imagine the market's probably going to recover from here. This might not be the end of the world, but the point is that I am preserving my emotional capital by not allowing myself to get into those trouble situations. This is very important. Don't overlook the mental game when investing. The second reason, of course, we do want to avoid the next major stock market crash. This should be top priority on everybody's mind right now in 2025. Like I said, we're only down 6%, but in the last 5 years alone, there's been multiple periods where it went 20%, 25, 34. Who knows if this 6 is going to double or triple? And of course, the big thing we worry about is what if this is one of those major recessions that's going to come? It's just a matter of time. We definitely need to avoid those because, as I always say, losses are more costly to a fund than gains are beneficial. If you suffer, say, a 20% drawdown, well, it's not the end of the world. It takes about 25% after that to get back to break even. But if you do suffer a 50% drawdown in an extended recession, it takes a full 100% just to get back to break even. And remember, in the dot-com bust, the NASDAQ index dropped 78%, which means it's nearly 400% away from breaking even. And we can see that on a chart. These are the three indexes. This is inflation adjusted, but the NASDAQ was down 78%, and it took 20 years to get back to the same point. The vast majority of investors out there right now were not investing before, say, 5 years ago. Most investors are new. That's kind of how it churns. There's certainly not that many who invested 10 or 15, 20 years ago. But the last 5 years might feel okay to you. But don't forget that the last 25 years, 20 of those years were just clawing back the previous drawdown. You don't want to be that person. Avoiding these crashes is your top priority. And then number 3, this is a big one, participate in the next great wealth transfer. Now, I'm going to do a full separate video this week talking about this point because of how important it is. But of course, it's awesome to participate in bull markets. We've done it as well. Our performance has been quite good. And for anybody with a little higher risk tolerance than me, you can see I have also we've got the 4 strategies, total portfolio. This is what I trade. Full disclosure, I always trade the fully diversified portfolio, along with multiple other option strategies as well. But if you are a little bit more aggressive than me, you can go with just our top 2 strategies. But the point is, awesome. There's nothing wrong with trying to profit from bull markets, of course. Markets do trend up over time. You definitely want to participate in that. But the real value add, the point where you can accelerate your growth in relation to everybody else, and like I said, participate in the massive wealth transfer, those happen when you preserve your emotional capital, when you avoid the stock market crash, and when you have capital ready to go. At that point, a market crash isn't going to be scary for you. It's going to be the best opportunity of your life. You can make more money the year or two after a major recession happens than you probably can during a 10 or 15 year long bull market. If you know what you're doing, if you know how to tactically rotate into safety positions. This isn't something that's done on a whim. There are volatility metrics that can tell you when to do these things. Like I said, we are dividing the market up. And that's the whole game. Knowing when it is okay to be short volatility. Knowing when you do have to cycle into safety, like we have the last couple of weeks into gold. And knowing when the time is right to strike to actually flip that switch and make money when everybody else in the market is losing. That's what tactical investing means. This is what I've been specializing in for all of these years. And I do believe now more than ever, this is the time to actually, like I said, we don't have to completely exit the market. If the market's going to go up for a few more years, awesome. We're going to be there to participate. But now would be the time to at least keep an eye on that exit door and make sure that your portfolio is bulletproof to the point that when it happens, because you're not going to know until you're in it, right? This isn't one of those things where you're just going to have a gut feeling and you're going to just time that thing perfectly. That's not going to happen. You have to have all of these rules and mechanisms in place ahead of time so that you're just following the process. So that's what I've set up for myself. I'm very confident that I'm going to get those signals. Yeah, there's going to be a little bit of whipsaw here and there, but we're going to get those signals. We're going to preserve capital, and I'm planning to thrive in the next market crash. So that's what I would recommend. Adopt this philosophy, and I think you're going to be just fine.